Welcome to the daily update, where I'll go over the action in the market for Wednesday, January 22nd, and we'll see how things look for Thursday, January 23rd. Had an up day for the S&P. We had the mega caps and especially the AI sector. It really likes that bill, that $500 billion proposed bill. And a lot of companies are really benefiting from that. So we saw the mega caps and growth have a good day. The rest of the S&P and the rest of the market actually was more negative. This could end up being positive because there's some charts that I'll go through where we were starting to get a little extreme. And these aren't our usual charts that show good momentum. These are the charts that are like, okay, something could be happening here. And we worked off some of those. And now we want to keep an eye on those charts because in case they turn more negative. But for right now, they're just working off these extreme readings. But we're still looking positive in the short, intermediate, and long term. So, right at the open on Wednesday, we had a gap higher open, and we've been seeing that a lot lately. Most of the gains have been coming from the gap. And we got above R2 at 6,081, and then we went up to 6,100, and that was about as high as the market was able to go on Wednesday. We drifted down below 6,100, but we didn't see any real intense selling. It just kind of drifted lower, but we still stayed above R2 and then ended up closing above R2. We were up 0.61%. We're still pretty healthy with volume. We're above average there. We are positive in the short, intermediate, and long term. We're still looking overbought in the short term, and I'll go through some of those. And we have a few of our charts that are looking a little more intermediate term that are giving us some concerns there too, but they're working off some of those conditions. So, some comments. We did set a new intraday all-time high, not a closing high. We didn't quite get there. We got above 6,100, and that set the new intraday high. Mega caps and semis did outperform, where the broader market ended up declining. There, in yesterday's video, I talked about tariffs are possibly being planned for February 1st for Canada and Mexico. Well, now we have another announcement of a 10% tariff on Chinese imports. And then this is what really drove tech and semiconductors and AI on Wednesday is this $500 billion AI infrastructure bill. Small caps, though, they came right up to their 50-day moving average and they're coming back down now. So that's still acting as overhead resistance. Whether you look at the S&P 600, which is the small cap index, or the Russell 2000 small cap index, we're seeing the same thing on those charts. And I'll show you those later on. The bank ETF is now back under its 50-day moving average. We were able to get above that. Now we're back below it. And here's our list in the short term. The rate of change going back 5 periods. We've been going up pretty fast over a pretty short period of time. And then we have our usual charts that typically will just show, yeah, we're going up or we're going down. In this case, we're going up. The Stochc RSI, Williams percent R, CCI 14 and 20, and the stochastics. No real surprises there. What's giving us a little bit of a concern, we're getting a little extreme with the force index. We don't see that one as often. It's hitting the upper Keltner band. And this is the one that I've kind of been honing in on. The McClellan oscillator for the S&P and the NYSE, that's more short to even somewhat intermediate term. And when that gets extreme, we want to pay close attention to that. Even though it still has more room to run to the upside, it was still giving us very high readings, and we're still far away from the 20 period moving average. Intermediate term, still having the CMB composite and the PMO studies. This is the one I've been kind of honing in on here. I'll show you a chart of that. And then the Sean trend meter is still looking, it's not full blown extreme positive, but it's getting into that area. And no change to the current scenario with the Fed pausing their rate cuts and increasing their inflation outlook. We were up with the dollar, we were up with interest rates, and we closed at 4.6% with the 10-year yield, where we had been at 4.57%. And even though we're negative with sentiment coming in at 43, the context is that we're positive. We've been showing some improvement. This could actually be positive for the market because you got a lot of people that are expecting the market to go down, And so they're hedging and sentiment isn't extreme positive. And we keep going up, at least for right now with the S&P. But we're not trending. We're in the process of switching over from negative to positive with our ADX chart. And in the meantime, we've dropped below 20 with the ADX itself, and we're also below the moving average. That suggests a weakening non-trending environment, but it's still positive with the green line above the red line. With the up day again, our bias is positive and our momentum is positive as well. We did get the weekly MBA mortgage applications index, came in up 0.1%, where last week it was up 33 and a third percent. And the LEI, the leading indicators, came in down 0.1%. They expected it to be unchanged. Last time it was up 0.4%. So here's the weekly chart of the mortgage applications where it's well off of the previous week's reading. And we're coming back down just a little bit. We follow the blue line here for the LEI. It pulled back after November was revised upwardly here. And this is the chart that I look at the most for telling us, does this chart suggest we're going into a recession or not? We're back above this red line. So the headline says the LEI is no longer signaling a risk of recession. Then the Isabel Net blog charts, we are improving here. We're coming in at 69.91. We're not extreme right now, but we had dropped actually down below 50, and we're looking a little more neutral after we had become extreme positive that way. And then looking at the valuation, you take the US stocks and we're up over that 20 level. We use the 10, 15, 20 scale for not only historical PE ratios, but forward-looking PE ratios. And we're at 22.2. We're above that 20 level. Now, if you take out tech, we're just barely under 20. So we're just a little bit under being extreme as far as earnings outlook there, or expensive. And then you can compare it to the rest of the world, and the US stocks are the most expensive right now, but they've also been performing the best. Where's most of the money going? Just like what we usually see with this chart, it's going into tech. And then the gap between the Magnificent Seven in the US and the granolas, which is kind of the equivalent in Europe, it just shows how they're underperforming. And then this could end up actually being positive. These are individual investors, and I usually go over this chart in the weekly video as well as Friday's daily video. They really declined. They were actually turning more negative, and we hadn't seen that in quite a while. In the 50-day moving average, you don't see it here. It's on the chart that I show. It's rolling over for the first time in quite a while as well. Now, this could be positive in that folks are suspicious. Folks aren't trusting this upward move that we've seen, and that's what the market likes. When the market really starts being taken for granted, that's when it tends to do the opposite. But this is more negative in and of itself, just by the reading of the chart. And this is kind of old news now. The dollar had really gone up to a high level and since has been coming back down, even though it was up on Wednesday. Then we've been watching a real strong correlation between treasuries, bonds, and stocks. And I go over this in the intermarket analysis video as well. And that's why we've been seeing this and saying if bonds are up based on price, then stocks are probably up as well. They've been going in the same direction. Earnings have really been dropping off as far as sentiment. Folks are more pessimistic about how do they feel in the US when it comes to S&P 500 earnings when related to the rest of the world. And then this is kind of interesting, dropping down here to 22% as far as the probabilities of a recession. And where's most of the money been going since the election? Still into the Magnificent Seven, money going into crypto, a lot of things like that, where we're seeing money coming out of longer term bonds. That's why longer term interest rates have been going up. In Europe, which we're setting all-time highs in Germany, and that's been pretty strong. So this isn't too far outdated over here. And China's been under some pressure lately as well. So we're seeing money coming out of that. And then this just shows when we look at equities, and we're more historically in line with not having a recession, where the red line, this is when a recession happens, and that's how stocks perform. So we're kind of sticking to what the stock market still believes, and we have other charts to back this up too, that I go over mainly in the weekly videos that show that the market is anticipating that we're not going to go into a recession. But we're seeing things a bit out of line here when we look at the historical movement of the 10-year yield. It's been really going up, which is deviating away from what we usually see. Here's our intraday chart. And as I said earlier, we're seeing a lot of the recent gains on Friday, on Tuesday, and then on Wednesday. It's coming right at the open. We're gapping higher and then able to hold on to those gains. On Tuesday, we gapped higher and actually moved up a little bit there. We gapped up and then just kind of floated sideways. We hit 6,100 and then came down slightly from that and down just a little bit in the initial overnight session, but things were going positive in the initial overnight session for Wednesday's session. Then we held on to those gains after Europe opened and then just started to see more strength going into the US Open, not the golf tournament. We're still looking good here when we look at the intraday chart of growth to value. The blue line's still well above the red line. And we had a good day with growth to value intraday for the S&P. Our end of day charts were showing that growth was up where value ended up being down. We were down less with the mid caps and down a little bit less with the small caps. So our end of day charts still looking pretty solid here for the small caps, even though they pulled back, breaking out with the mid caps, even though they pulled back, and breaking out with the S&P 500, and it ended up being up on the day. Seeing a bit of an improvement with the growth of value ETF here, but we're still in the rainbow. And discretionary to staple, still looking pretty strong. And this is positive for the market. We're above the 50-day moving average, and we broke out of this series of lower highs and lower lows. Now, I've been mainly pointing this out with the S&P chart and even the weekly chart of the QQQs, but to see it here, since large caps are such a big part of the indexes, this is showing an improvement where we're breaking out of that. And looking at the trend, we are below 20 with the ADX and we're below the moving average, a non-trending weakening trend, but it's positive. We're seeing the green line going up and the red line going down, seeing pretty much that same thing with the short-term chart as well. Not trending, but positive. And we're above average with volume. Had the latest reading of investors' intelligence coming in at 1.48, so they haven't turned full-blown bullish yet, but there's about a week lag with this survey. The Ulcer Index is coming down, but still just a little bit above its moving average as fear has been coming out of the market. We ticked up just a little bit on a closing basis with the VIX and also up just a little bit with the bar chart here. We were up and we're in between the moving averages with the VIX of the VIX, but the momentum of the VIX continues to be down. And we're still getting a high reading here with the skew index. We're up into this red area. The market is still expecting some kind of a big move that hasn't happened yet. We ticked up with the daily chart of the equity put call ratio, and we're going back up with the 5-day and the 10-day now. And this is the only thing on the negative slide when I get to the end of the video. That's it. Everything else is positive, which that's when nothing on that list, that's negative in and of itself. When you have everything seeming to fire positively, that's when it's like, okay, the market likes to, from a sentiment perspective, we're not seeing that, but some of our indicators are looking pretty positive right now. Some of them too positive. We ticked up a little bit with this fear gauge as well as the other fear gauge. So a little bit of fear coming back into the market. We're going back up with our risk on to risk off ratio as the high beta stocks like the Apple and Google and Nvidia, those ended up having a good day. Coming back up a little bit, but still below the band with volatility risk premium. Not seeing a real massive increase in fear looking out 30 days. Ticked down a little bit based on price with the advanced decline line, but we were flat with the advanced decline line based on volume. Still seeing a real expansion in new highs, even though we're off of what we saw on Tuesday. And we're going up with the 5-day and the 10-day. So internally, this is still looking solid for the S&P. Came down, but still above zero with our short and intermediate term advanced decline ratio. This breaks it out based on price where we're positive, and we're still positive based on volume. The first smart money indicator that we look at, we're above the moving average. The boom indicator is not really giving a realistic measure of how far away we are from the moving average. The smart money indicator number two, the Chaikin money flow, is still going up and the red line's going up. And we ticked over a little bit with the Chaikin oscillator, but we're still above the moving average. So this can still be considered positive. We did cross a little further over, and now we're positive with the vortex, with the green line going up and the red line going down. Not much of a change here with the cumulative advanced decline line based on price for the S&P, and we're pretty much flat based on volume. This is one of the ones that I've been a little concerned about, the advanced minus decliners with a 10-day moving average. We were getting above this red line. Now we could still go higher, but sometimes this goes up and starts to come down before we see that in price. So we want to keep an eye on this, but the fact that it's coming down is wearing off some of that extreme reading. That's positive because we could still go up again. But if this continues to fall, that could morph over into something more negative. And we went up with the S&P where we came down with the NYSE advanced decline line. So a bit of a divergence there. You could see it as positive if you're involved in the S&P. You could see this as more negative if you're in the broader market. Still improving here with the 10-day average of the highs and lows for the S&P above 50 and continuing to go up. And we did come down with the cumulative advanced decline line for the NYSE, but we're still above the moving average. Tick down slightly. It's still above the moving average with this regular NYSE advanced decline line and this other NYSE advanced decline line. Tick down a little bit with the common stock on the NYSE as well as volume, but nothing real major, at least yet. And seeing a little bit of weakness here, but we're still above the moving average with the common stock, the S&P, and the mid caps, where the small caps are starting to drop back below the moving average. This is still positive now with the broad market 5-period moving average of the highs and lows. We're above zero. And coming down, this is another one that I've been pointing out that maybe we're getting to a pretty high reading. Now, when we go above 70, that's good, and that shows good momentum. But when we start to get above 80, that's when we get a little concerned because you can only get up to 100%. And so this acts like an oscillator. The fact that this is coming down could be positive, but if we continue to see this decline, that could turn into something more negative. And here's the actual study where we went above 70 and we're pulling back slightly now. We actually dropped a little bit below 50 with the 50-period moving average study. We declined, but we're still above 50 with the 100 study. And we declined, and we never were below 50 with the 200-period moving average study. We're above average with volume down here, and we're still looking pretty good. We were able to get above this pivot point, but we're not seeing an awful lot of intraday action. Like I said, it's really coming from the gaps right now. The rate of change going back 5 periods is still looking extreme. So we went up pretty far, pretty fast. And when we get high readings, it doesn't mean we're going to reverse. It just may mean that we slow down, but we really haven't started to slow down, at least yet. We did decline a little bit with the 20, 50, and 200 period moving averages on the S&P. We're still extreme, even though we're coming down with the boom indicator. We're still kind of far away from the 20-period moving average. Now, these are the usual charts that show that we're showing good momentum. We can stay up extreme with these charts for quite a while. And that includes the Stochk RSI, the Williams percent R, the CCI 14, and the CCI 20. And even the stochastics rolling over a little bit, but still extreme with the short term, going up in extreme in the intermediate short term, and still positive in the long short term, which is a further subdivision of the short term time frame. Getting a little extreme here, we're hitting this Keltner band here with the force index. The condition of the short-term trend is improving. We're seeing the blue line and the green line going up and prices above both. And we're above the 20-period simple and exponential moving averages, and the blue line is starting to go up above the red line. That's looking pretty positive for the time being on a trend basis. And we're up at the high end of the +2 channel with our standard deviations chart. We get more concerned if we go into the +3 channel. Balance of power right at 0. So it's at equilibrium right now. The CMB composite is above the black line and going up. That's extreme. Still looking kind of negative. The go, no go isn't quite sure. It hasn't switched over to positive yet with the brown bars now. And actually going above the highest high value here on this chart, and the midpoint is starting to go up. The TTM squeeze continues to improve and turning more positive. We're going back up with standard deviation. That's speed over the last 10 sessions, and this is calculating this big move up that we've been seeing here. And we turned positive with ease of movement. We finally were able to cross back above zero. The Erin also came back above zero as well. And this is another one that I was watching, the McClellan oscillator for the S&P, giving us a very high reading, coming down off of that. Now it's still extreme, but it's wearing some of that off while the S&P was still going up. Now that could be positive, but at the same time, we want to see if there's more weakness that ends up coming into this, is that going to feed over into price at some point? But the summation index based on price and volume continue to go up, and we're crossing back above zero based on volume. That's positive. And also coming down after being barely extreme with the NYSE McClellan oscillator. Also the same thing. We're working this off. We're still positive though after getting above this red line. This could give us more room to turn and go back up, but if this gets weaker, this will continue to go down. And we're going up with the summation index based on price and volume. Also another thing, the Swenlin trading oscillator, getting us an extreme reading, coming down from that slightly. Even with the S&P being up, we're still advancing based on volume. Momentum is turning back to positive now. The PMO's up. We're up based on price and volume here. And coming down, but still extreme with the PMOs that are rising. We're still going up with the buy signals. We're going up with the PMOs that are above zero. We're positive with the parabolic SAR, and we're positive with the Elder's Impulse system for the S&P with the green bar. Short-term momentum going above the midpoint, above the moving average, that's positive. The MACD going above the midpoint, above the moving average, that's positive. So in the short and intermediate term, we're back to positive, and we're almost crossing over with the tricks. We've already crossed over with the KST. These are our two longer-term oscillators. And then another momentum oscillator is the Copic curve, which is crossing above the midpoint and turning positive. And this is the Sean trend meter getting up into this little darker green area. Where we get really extreme is if we get into this really ugly green area near the top. Back above 50 and going up with the money flow, above 50 and advancing with the ultimate oscillator, above the moving average with on balance volume, above 50 with the RSI 14, that's more intermediate term, and the 9-period RSI, that is short term. Seeing an improvement with the intermediate term trend, we're above the blue and red line, and they're starting to turn back up. Above all the plotted moving averages right now, and that's positive. We're still going up with the bullish percent index, and we're above 50. That's positive. Crossing back above 50 with the NYSE bullish percent index, and continuing to go up with the NASDAQ 100 BPI. And we're turning back more positive with our Ichimoku cloud. The studies that go with this green and red cloud here, the blue line's starting to go above the red line. The green line's going up, even though it's really hard to see. And we're coming up out of the cloud. So this chart is turning more positive. We're still coming back up to the upper end of this trend channel going back to 2009. Is that going to provide some overhead resistance if we continue to battle at these levels? We're positive with the Heiken Ashi chart. We're positive with the Kigi chart, black and pointing up. We're positive with the Renko chart, and we're positive with the 3-line break. And we added another X in here. So that's showing that this is improving. We were concerned that maybe we had topped out right around the 6,000 level. Well, then after Tuesday, we had an X. Then after Wednesday, we had another green X drawn in here. So this is improving. Long term, we declined a little bit with the 150 and 200 moving average studies, but we're still well above these blue lines. Still looking pretty solid. And we're getting a higher reading with the ZWAG NYC breadth thrust, but we passed the 10 days. We go above 0.4, and then we have 10 trading days to get up to the red line. We didn't do that, but I'm showing this chart anyway because this still suggests good momentum. But there's a 1-day lag with this chart. So this is showing Tuesday's close, not Wednesday's. And we switch back to negative with the small caps in the intermediate term. Everything else is positive on all time frames. Bonds have switched back over to positive in the short term, negative in the intermediate and long term, still positive across the board with commodities. The dollar's now switched to a downtrend. So it's actually been under some pressure lately, but it's still positive in the intermediate and long term. And we had tech and communication. Those are true growth areas. That's what we want to see. And they were up, where all of the other sectors ended up being down. Discretionary was actually down, but staples were down more. So that's why the ratio is still going up. And financials saw a bit of a give back there after it had been doing well. Everything was green or blue, with the Nasdaq going above 19.8, then 19.9, then above 20,000. We had the S&P going above 6,100. We had a BPI cross above 50 with the Nasdaq. Communication had a MACD bullish crossover, as did the tech sector. These are positive technical analysis events that are happening. But if you look at the time over here, a lot of these happened right at the open. And we came down a little bit with the equal weight, where we're going up with the weighted version of the S&P. Now that could be positive. You could also read this as more negative, as a divergence with the broader part of the S&P actually declining. And we going back up here, showing that the weighted version outperformed the equal weight version. The Dow was up 0.3%, still looking pretty solid there. We're still positive with the diamonds with the Elder's Impulse system. The NASDAQ was able to get above this R1 pivot point and close above that. So that's looking more positive. And the NASDAQ 100 also above this R1 pivot point. That's still looking solid for the time being. We're positive with the QQQs with the Elder's Impulse system. The momentum is now turned back to positive for the NASDAQ 100. This was the 50-day moving average for the S&P 600, the small caps. We came right up to that, and now we're starting to decline. Are we going to be able to go back above that? Or are we going to go back into that pattern of the small caps do really well and then spend the next number of sessions giving those gains back? And we're seeing that same thing with the Russell 2000. We came right up to the 50-day moving average, and so far this is acting as overhead resistance. After the 200-day moving average, it acted as support. We're still positive, though, with the Elder's Impulse system for the small caps. The mid caps came up to this R1 level. We opened right about there and then ended up coming down, but we're still above the 50-day moving average. We're still positive with the Elder's Impulse system for the mid caps. Declined almost 0.5% with the financial sector, but still above the 50-day moving average. But we're below the 50-day moving average with the bank ETF, as I mentioned earlier. Looking good here with the Wilshire. We were up 0.5% above the 50-day moving average and a longer-term uptrend. The total U.S. stock ETF was also up 0.5%, still looking pretty solid there. We're still declining with the staples to tech ratio, which is positive, meaning the tech sector is outperforming. And the FANG index really doing well and breaking out above this series of lower highs right here. And you could kind of make a case for lower lows, but the 50-period moving average provided support, and we're coming up off of that. And if we continue to go up with the FANG index, I'll extend this line out here to see if that becomes overhead resistance. And I usually only show this in the intermarket analysis video, but the AI ETF and robotics as well, it was up pretty strong. Now, what we've been seeing over the last couple of years is, even though AI is the rage and it's what everybody's talking about, it's been underperforming the tech sector. Now it's coming up here and hitting this 250 period moving average. Is this going to act as overhead resistance, or are we going to be able to break out and go up and actually see AI outperform the tech sector? We're not seeing that yet, but we are seeing an improvement. Apple was up a little over 0.5%, still above its 200-day moving average. Amazon was up 1.86%, setting an all-time high. Microsoft was up over 4%, getting back above both its 50 and 200-day moving averages. Google was up 0.16%. Not much of a change there. Meta was up over 1%, still looking pretty solid. Nvidia was up almost 4.5%, back above its 50-day moving average and in a solid uptrend. Tesla was down 2%, but still above its 50-day moving average. Netflix, really good earnings report, breaking out. But this is a little bit negative because we gapped higher and then closed at the low. So there was some selling on the news here after we'd been seeing an improvement. And if you hear noises in the background, I apologize. Just consider it background ambiance. Semiconductors up 1.82%, breaking out of these previous highs. And that's a little more apparent here. We were worried about this. We came right up to this 260 level and then started to go back down. We're breaking out above that now. Can we continue to go up with that? And the semi to tech ratio actually declined a little bit because tech had a really good day, even though semis had a good day as well. And the Dow Jones Semiconductor Index, it was up 2.81%, looking solid there. Still showing a downtrend with the stocks index, and it was up 1.45%. Look at the relationship between US and international stocks, showing a little bit of an improvement with the short-term correlation. The longer-term correlation is still improving. Oil is in the mid 70s now. It was down another 0.5%. And the dollar, after really going up solid, has been pulling back lately into the 108.28 range. And we went back up with the 10-year yield after we had been declining. We'll keep an eye on that. We want this to continue to go down. And if we look at this 45 here, that's 4.5. If we could fall below that, that would turn things even more positive. It's when we broke above this 4.5% level, that's when it really started to pressure stocks. So if we come down here, will this act as support and then we'll bounce up from there? If we break down below it, that could be more positive. And we're coming down a little bit with bonds based on price. We're still above the 200-day moving average with the total bond ETF. So that support is still holding for now. Seeing a little bit more of an improvement with the home construction to 3 to 7-year bonds. What we're watching for is if we get back up to this 250 period moving average, is that going to act as resistance where before it acted as support? And we're keeping an eye on the Japanese 10-year yield, because if that really starts to go up, that could trigger what we saw last summer. Seeing a little bit of an improvement with the Qs to S&P getting above the moving average, but declining with discretionary to S&P. But when you look at discretionary to staples, it's looking really strong. And we're coming back up to the moving average with large cap growth versus large cap value, but we're still declining with the moving average. So coming back up to the moving average with the large caps, really looking good here with the mid caps and the small caps. So they're holding up, even though their indexes were down. We're still declining with the staples to S&P ratio. That's positive for the S&P. It means it's outperforming. So what's our outlook for Thursday? We're still dealing with earnings on a company by company basis. We're still positive technically, but we're still dealing with an overbought condition, even though we worked off some of that in Wednesday's session. We're going to get jobless claims. That's the big and pretty much the only thing coming out on Thursday. And then the geopolitical things, there's still this inauguration honeymoon nightmare, wherever your perspective comes out on that, that's kind of feeding a lot of the news that's happening right now because there's an awful lot of changes that are going on and companies are having a hard time keeping up. And let's see, on Friday, we'll get the S&P Global U.S. Manufacturing and Services PMI, as well as existing home sales and consumer sentiment. And that's what we see coming up for Friday, with the big one being initial claims on Thursday. Seasonally, we're neutral to negative with the Dow, we're positive with the S&P, and neutral to positive with the NASDAQ. So kind of across the board here, but we're still dealing with the week after options expiration, which is up 62% of the time, down 38% of the time over the last, since 1980. All right. And a little bit of positive seasonality in a post-election year with the green dashed line. We're coming into the second half of January. That's where we're at now, which seems to be performing quite well so far. Small caps, if they can they break above their 50-day moving average and start to see what typically is positive seasonality. And we're coming into the positive time here, according to Tom Bally's research, from now until the end of January. So the warning signs, this is it. And this is a little bit concerning in and of itself. This is the only thing on the negative side right now is the equity put call ratio 5 and 10-day charts. Everything else is positive, with our smart money indicators being positive, the growth to value and discretionary to staples ratios, those are still looking really solid. The advanced decline lines, even though they're coming down, at least for the S&P, it's above the moving average. And the S&P and NYSE McClellan oscillators and summation indexes, still extreme, but coming down slightly. Momentum is now turning more positive. Parabolic SAR, the Swenlin trading oscillator, coming down after giving us an extreme positive reading based on price, but still going up based on volume. A bullish percent index is still looking positive there. The vortex, we finally saw more of a definitive cross of green going above red. And our moving average studies are positive. We're still keeping an eye on the short term, the 20 period. It's coming off of an extreme reading. We're going to see if that morphs into something more negative. Ease of movement, that was on the negative side. Now it's back over to the positive side. The money flow and the ultimate oscillator are positive. The financial sector is still positive, and the momentum for the Nasdaq 100 is turning more positive. So our conclusion, we're still positive, but we're looking short-term overbought right now as the broader market declined. We are positive, but still overbought, but working off some of those indications in the short term. We're becoming more overbought in the intermediate term, but also working off a few of those conditions. And we continue to be positive in the long term. Thank you. Have a really good day. I hope you found this video helpful, and I will talk to you in the next video.